Good morning. This is Barry Knapp with Ironsides Macroeconomics. It's 10 a.m. Mountain Time on Monday morning, November 24th, Thanksgiving week. Our note this week was titled Adverse Aggregate Demand Shocks. And the main theme of the note was to really strengthen our case that the administration's policies, in particular trade policy, was not an inflationary shock. It was an adverse aggregate demand shock, meaning it slowed growth and ultimately it is raising unemployment and will ultimately be disinflationary, not inflationary. This was the theme of the San Francisco Fed paper going through 150 years of tariff history. It's our observations for what happened in 1819 and what the markets and economy's been telling us since Liberation Day back in April. So the note was structured. We had an initial section. We titled Canceling Santa, meaning there was the hawkish regional Fed presidents threatened to cancel the Santa Claus rally. We then went on to really dig into this adverse aggregate demand shocks. And so it's not just trade policy, it's also immigration policy and the slowing rate of government spending growth. We then had a section titled Gilligan, You Did It Again, which was some seasonal adjustment problems that flattered the headline employment growth in Thursday's delayed September employment report. Nonetheless, the labor market is decidedly weakening, and I'll discuss that in a minute. And then we wound up with some comings and goings around duration tightening, some things that came out of the minutes that did not get discussed widely last week, and the growing risk of a risk-off environment at the end of the year, which when that happens, like in 2018, can be quite ugly. So we were all set to really cut risk in our note this week until we got the President Williams from the New York Fed comments from Chile on Friday morning, that suggested that the chairman and Williams are probably still in the rate cut camp, and December is looking increasingly likely. So we may not cancel Christmas after all. We had a couple of Fed officials talk about non-housing services inflation. In the note, we have our case why that's not really the case. There's been some residual seasonality since the pandemic, but even with that, the 3-month annualized rate has been slowing. Cleveland Fed President Hammack said it's been increasing, and we're not seeing that in the numbers at all. But frankly, our scenario for getting the Fed to cut in December and again in January was predicated on the BLS releasing the delayed employment and inflation data and convincing the Fed that the data justified another 50 basis points of rate cuts. That's obviously been delayed till after that FOMC meeting. The Fed should probably postpone the FOMC meeting, but they won't do that. And so we are in a little bit of a funny spot now between here and the Fed meeting on December 10th. By the way, we'll be in New York that week, which should be quite fun. So moving on to this adverse aggregate demand shock, the San Francisco Fed paper, the effective tariff rate has moved up from 2.5% to 12.5%. During that time frame, the unemployment rate's gone from 4.1 up to 4.4. And as we discussed, the unemployment rate for the 16 to 24 category jumped 1% in September of 24 and 0.9% in September of 25. We believe that never actually occurred. That's a residual corruption to the participation of that age cohort in the month they're supposed to be going back to school in years where their school didn't exist or there were no summer jobs. So that data we think is off. When we go through all the details, and to get all those details, become a full paid subscriber, you could see them. The labor market is decidedly weakening, and that is the real risk that the Fed should be approaching. So we're at the point where adjusted employment growth is almost at 0.05%. That's adjusted for the overestimation of the birth-death model. The Fed is very much betting that it's different this time if they don't ease into that, because Once the unemployment rate starts going up, it goes up non-linearly, meaning really rapidly. So on the one hand, they're not basing their views on tariffs on history, but they are willing to fade history with respect to the unemployment rate. Very curious position, and sort of makes you wonder whether there's some ulterior motives here. So the labor market clearly is weak. That's a big issue. That the issue that did not get discussed last week widely was it was very clear from the minutes that the Fed intends to shorten the duration of their portfolio over and above reinvesting mortgage paydowns into treasury bills. Ultimately, they're going to be doing that with much of the rest of the portfolio as well. That will put pressure on long-term rates. There's lots of discussion about, another round of QE, increasing liquidity, increasing bank reserves. None of that really matters. What's important is what's happening to the duration of the Fed's portfolio. The administration and Fed have every intention of loosening bank regulatory requirements to get banks to absorb that supply. But this is going to be a real balancing act next year, as the administration has every intention of running it hot and increasing growth, getting the incentives from the One Big Beautiful Bill Act to kick in and strengthen growth. On the other hand, the Fed is going to be reducing the duration of the portfolio that could put upward pressure on rates. And so we're in a tricky environment. If growth is slow, rates will be fine. But if growth accelerates, we will have a problem in the back end of the Treasury curve. So we'll get our outlook note out before too long, and you can see all the details then. So on balance, we took risk down. We raised our cash holdings from 7% to 12% this week. The rally we're getting this morning is a good opportunity to lighten up your risk. And we think we may get a little bit of a Santa rally, but we've had the bulk of the rally for the year. And next year, we think in the first quarter, the markets could struggle. Barry Knapp from Ironsides. Have a good week, everyone. Thank you.